Hi everyone, welcome back to my channel. Today I want to do a video on a new TradingView feature called DEX, which stands for Delta Exposure. This feature has some very exciting uses when paired with some simple market structure concepts that I'm looking forward to sharing with everyone. If you aren't familiar with what market structure means, be sure to check my previous videos. I also plan to do a follow-up video on how we compare this with gamma exposure to take some amazing intraday trades. If you aren't familiar with delta and gamma exposure, be sure to check out my recent video on dealer hedging and options Greeks. Before we get started, I'll leave several referral codes for great trading services I use on this channel in the description, including TradingView, Rocket Scooter, and TradingView. That will give us both discounts. Lastly, if you enjoyed this content, don't forget to like and subscribe to help me grow this channel. So what I have in front of me is Market DEX. Now you can find this on the market dashboard if we go to options. My favorite tool, really, Market Net Flow, is shown here. If we scroll down, now we have this Market DEX. Now, it shows options flow across the entire market, just like Market Net Flow does, but it shows, instead of showing options net flow between calls and puts, it's actually showing raw delta exposure values. And it also has a 5-day moving average that you can see here, which can help. However, I'm gonna turn this off for the purposes of this video, which you can do so by clicking this. And then you can see this orange line is the price of SPY, and then so it tells us here positive DEX often precedes a move up. So positive DEX is shown by these green bars, positive delta exposure, and negative delta exposure can anticipate a move down. Now, I talked about this in that options Greeks and delta head and dealer hedging video that you can check, but essentially what this means is that if we have positive delta exposure, that means dealers are short on delta. So typically it means there's a lot of call buying and put selling happening, and that means dealers then have to are on the opposite side of that. So they've sold those calls and they've bought those puts, which gives them directional risk to the upside. So to hedge that, if they're hedging it on SPX, they're typically buying futures, or if they're hedging it on SPY, they might even be buying the underlying at certain points. So, and this applies to more than just SPY, but for this video, we are focused on SPY here with this delta exposure. And that does correlate with a lot of the rest of the market. So we can see just at its very basic, so even if we don't do any sort of technical analysis, this is very powerful, because when we look at this, and I'll show some back tests here, we can see that when the delta exposure goes positive for sustained periods of time, we typically have SPY's price moving up. And then when it goes negative, we have a drop on SPY, and then it shifts positive again, and we move up. Whenever we see it go negative, we have these dips, and then when it shifts positive again, we get rallies. And so you get the idea there, just as showing. And one thing to note about this is it's showing the delta exposure from that. You can look at this the night before market opens and help make trading decisions. It's really meant to be used at either the end of day or the beginning of the day. And I'll go into a video of how I like to use it intraday. It really helps me lines up some great trades, but for this video I just want to focus on swing trades. Now what's nice about this is you can go and you can say, okay, just show me the past 60 days, right? And we can get rid of the moving average here. You can say, you can change that there. I'll set this back to full. You can also change what that moving average shows as, if you want to make it based on 10 days or lower value, 1 or 2 days, whatever you prefer. Now, in this case, I'm not really going to be using the moving average, so we'll just make sure we hide that here. But this also correlates with this chart here, which shows the relationship between total DEX and versus a 1-day future change in SPY's price. And what's interesting about this, if we look at the deltas that we had today, what you can see is 0.112, and then we look at roughly where that would be on this chart. So if we go to these little dots here we go, 0.12, we can see that, or excuse me, that would be 0.112, I think we were looking at here. So, but you can see with these dots, it essentially shows when these deltas are the way they are, it can lead to some big changes in SPY's price, percent change wise, which shows on this bar on the left here. So you can basically see what typically has happened in the past. It's looking at historical data to determine this when we would see large price swings. Now this, it's worth noting, this is purely looking at the deltas itself. It's not taking into account Vanna, which could be pulling liquidity out of the market, which would make the move smaller, which wouldn't make them as wide because of the changes in volatility. However, it's nice to get an idea of what type of price movements we could expect when deltas are positioned the way that they are. So now you can actually just trade this solely, and I just want to show what I mean by that quickly is if we go to DEX and we want to say, okay, if I were to buy based on this, so like let's just say when DEX flips green, I'm gonna take a position and take a call, and I'm gonna hold that call for, let's say, 10 days, and my stop loss is gonna be 2%, which is a pretty reasonable stop loss. And that would be 2% of SPY's price. That's not saying 2% on your call option, because obviously we don't, you know, there's several factors there based on the call option you select. So your stop loss is 2% of SPY's price, or you could go and set it to 1%. You can actually hit backtest. And this is an incredible equity curve. And if you look at this, this is essentially saying that if we did exactly that, so when the delta exposure flipped green and we bought, or when it flipped red, we sold, and we just put a 2% stop loss on SPY's price, and we closed out of that position within 10 days, this would be our equity curve. So you can see it starts out pretty green, and then we actually go negative for a little bit. So we have a little bit of drawdown here, but nothing too crazy. And then as SPY starts to go into this trending state, because right here was sort of choppy, we had a lot of back and forth on these dates, but as it goes into more of a trending state, we start to see our equity curve increase. And now these are for swing positions. So meaning you're swinging these SPY calls, say you buy them 2 weeks out, and so essentially you plan on closing them within 10 trading days. You can see how this just rapidly increases. And so when it drops here, we exit out either because we close the position or it hit our stop loss, and then we enter a new position and essentially trail our stop loss with it. It's a 2% trailing. And as we keep moving up, we just keep seeing our equity curve will dip a little bit here and there when we get these little drops down, but then it picks right back up. And it really helps you take advantage of these trending markets. So essentially what it's saying is when SPY is going up and we see the delta exposure in the green, then we would buy calls, and vice versa. When the delta exposure is down and we see SPY's price going down, we could then buy puts to take advantage of this. And we just want to make sure, using proper risk reward, that we set a stop loss on that. And when the market blows up, so you can keep swinging these every 10 days, 2 weeks, whatever you want to do, and you can just see how this increases exponentially. And one thing it's worth noting is that SPY has actually been down. Now in this period of time, it's slightly up because of this recent rally. However, it's not up in any meaningful way, right? So when this started here, SPY's price was right around 417.40, and at the close here, we're looking at around 427.10. But so we're roughly 10 points here that SPY's up. However, in this case, from this back testing, you can see in that same time frame, our profits are 197% cumulatively, just from implementing this with no sort of technical analysis. It's just, if SPY's up and the deltas flip green, we buy. If SPY's down and the deltas are red, we buy, excuse me, if they're green, we buy calls. If they're red, we buy puts. Or you can either go long or short if you don't like doing options. And that's some really incredible stuff. This is the first time I've ever seen a tool this powerful that doesn't require any sort of indicators or technical analysis. So that on its own is pretty amazing. But what I want to talk about is a strategy that I do actually intend to use, and it's pairing this with just a little bit of technical analysis, just essentially trend shifts and market structure breaks. So let's jump over to SPY's chart here, and I also do want to make sure we do this with VIX. So let's go back. So I already picked a date here, and to be fair, I am cherry picking here, but it's just for the purposes of this video. I encourage you to look at this on your own and see how this pairs together, back test it and see if this is a strategy you might use, but it's one that I certainly plan to use. So we had this rally in SPY all the way through post-COVID through 2020 into late 2021. And then we started in November, we saw some sell-off, and then it came back, some unusual, larger than normal sell-off, and then it came back. But all of a sudden, when we start getting into January of 2022, we come down here, and I'm just pick this one because what we see here is we cap out, right? We can't seem to break this level. We've had this consolidation, and then we sell off. And at the time, there was a lot of news coming out about inflation being high and all of the money printing catching up. So there's some macroeconomic events in the news that we can take into consideration. And we come down, we make a higher low from the previous pivot. However, all of a sudden, we make a lower high. So this is considered the change in market structure. And we can see it ends up becoming, and I'm looking at the SPY 1 hour chart, it ends up becoming a double top off this previous level, which if we scroll back, we can see it's topping. The prices hit here before. We did break through it at one point, but we fall below it. Now we can't get back above it. So this happens on January 13th. So here we could be thinking, okay, if delta exposure goes red, I'm going to enter puts. Now, let me refresh this just to get back to where we were, and then I'll turn off the moving averages. And this is just some basic market structure concepts of higher lows and lower highs and such. And so if we look at that was right around here on this point in SPY's chart. So on January 13th, we would have seen, we see price struggling. January 13th, we get a red delta exposure bar indicating that, okay, we failed to break over this. You can see here, this is January 13th, and we start dropping. So we check it for the day. January 13th was red. So we enter puts, whether it be end of day or the beginning of the next day. Either one is fine. And then we could set a stop loss above this level, because I don't usually typically like doing stop losses based off percentages. I like my stop losses having some sort of meaning. And what's nice about this on the hourly chart is that we have our confirmation that this level did indeed hold. Now, of course, we miss some of this move because we didn't enter in right away. So we would actually be entering in the following day, because or end of day on the 13th or the following day on the 14th. And when that happens, it actually looks like we might continue, but we entered our position in, and we just proceed to have this massive sell-off that we could essentially trail and hold on a swing position. And let's say you bought these puts for 2 weeks out, so all the way, so we get to or even 1 week out really, so we get to January 21st, and from this point, let's say we bought it somewhere in the middle here on the 14th, so let's say it was like, we'll say right around 10 a.m. on the 14th. So if we bought it in around 462.39, and then we get to the 21st, and we go to end of day on the 21st, we can see it takes us down to 439.22, and we just catch this massive move all by pairing it with a little bit of market structure on the hourly chart. And you could also use the daily for this. I was just showing the hourly chart, but you can see on the daily it's the same sort of thing, where we see this big level that we failed to break above, and then we sell off, and you could just hold through most of this move. You could even consider rolling your puts if you didn't buy enough time initially where you close them out for profit and then open new puts, just as long as you take into consideration that the deltas are staying negative. Now you'll see here that they did go positive. I mean, they did go positive a little bit, like on the 14th, but then they were negative again on the following Monday, and then they were very low. But if you tie in that price action, then, and you account for it being a swing play, then there's no reason why you should have to let go of that. And you can even do the same thing when it does pivot back higher. You can play that little upside pivot, depending on how aggressive of a trader you are. But I also want to look at a more recent example where we could have taken some calls, and this is actually some market structure I noticed myself. So again, we'll base this around a market structure break. So we can see that we had this area of consolidation that was centered around PCI in early June. Massive sell-off, and then we came up, held this level, failed it again, tested it again, held it again, failed, and then eventually we broke this level. Now, we don't necessarily want to take a play right out of the gate. We could have. So this was July 19th, 2022. Let's see what the delta exposure looked like. So yeah, that we had some big green delta exposure, so we could have certainly taken a play there. But as a more conservative trader, I usually like to wait for a retest. So we would have missed this moving up, but that's okay. It comes back down, and when we retest and hold, we're looking at this on July 26th, and essentially what we want to do is confirm that we have, so July 27th, we get our green, a huge green bar on delta exposure, and when we see that, that can be our cue to enter in calls. And at this point, you know, you could buy a week or two of time on these SPY swings, and essentially that would have allowed us to cautiously enter, right? Because we had our confirmation of a hold, we let things play out, we see that the delta exposure shifts green, and then we could essentially hold our swing play until we see some sort of market structure break. And you can see as it was moving up, every single time we were making higher highs, higher lows, higher highs, higher low, higher high, higher low. No reason to exit out. So once again, if you didn't buy enough time initially, you could even roll those calls, just assuming that the day that you're rolling them on, delta exposure continued to be green. And so as we come up here into the future, you could see that while we are still green on today, the delta exposure has dropped significantly, and there's other factors indicating that we might be entering a period of consolidation. So at this point, it'd be a good time to close our calls. And the big reason I say that is because we have FOMC this week. This video might be released after FOMC, I'm not sure, but we can see here that we're at this key level on the daily chart, and we have key macroeconomic events happening. So this would just be the perfect time to exit, which we would have gotten in on these somewhere around here. So we could have taken 402.50 roughly all the way up to around 429, and that would have been another massive 29 point move that we call it. And of course, if you're looking at the money calls 2 weeks time, that's insane profits. So that's a really conservative way to play these, but like I said, you don't even need to be that conservative. I just wanted to show how you could simply pair, not using anything else, just price action, market structure, and the DEX chart, what you could do with it on these swing plays. So hopefully that gives you some ideas how to use it. Like I said, I encourage it to back test it, put in stop losses that you're comfortable with, and forward returns that you're comfortable with, and do some back tests to see how that changes the equity curve. Actually, that's pretty amazing. So if you do 15 days with a 1%, at no point do you enter any drawdown, and you end up with roughly 410% in profits, which is just absolutely absurd. I've never quite seen anything like this, and it's just important to play with this chart and understand it, and just the power. And I myself, I'm starting a new job and stuff, so swing plays are going to become more, usually I day trade, but I'm going to start swinging more, and this is probably going to be my go-to tool for that insight, since I won't be necessarily watching market net flow intraday. Rather, instead I'll be using market DEX for my swing plays on SPY. So hopefully this gets like as exciting to you as it is me. I can't wait to start using this in real trades, and I'll do my best to try to document those on Twitter as I have time. But anyway, if you have questions, let me know, and I appreciate you watching.